Hi, everybody. It is Wednesday, August 7th, 2024. Welcome back to Ox Talks. I appreciate each and every one of you being here, watching the shows, most importantly, sharing the videos with as many people as you guys can for me. We have something or some things or somebody that really doesn't want to see this channel grow, and we're really getting held back on subs. We're having a reduction in subs for no reason at all. So I need you guys to help me out. Let's everyone spread the videos out there for me, and let's get those that aren't subscribed subscribe to the channel. I'm going to continue to come out here and offer my insights, share with you current events, and continue discussing this economic collapse as it's unfolding in real time. I'll jump into a couple stories I have for you today I want to share. I did a live show Monday morning when the markets were, worldwide markets were really collapsing. Stock market in Asia, the United States stock market, cryptocurrencies, gold and silver, everything really was falling precipitously on Monday. And I wanted to, instead of coming back out Monday afternoon and doing a recap, I wanted to let this play out for a couple days and see how the market settled in, what was released in the news cycles that would be of worthwhile nature to kind of share with all of you. We're now Wednesday, a couple days later. Before I jump into today's articles, the stock markets for U.S. did sell off into the close this afternoon. I was sitting here watching it, and the markets were up earlier today, and I believe leave your comments below. I believe the markets sold off at their lows of the day. The Dow, the S&P, and the Nasdaq. Again, not a market expert by any means at all, but usually that signals weakness. When you have a market not only sell off into the close, but also close at the low of the day. I saw yesterday as well, the markets were up big, the U.S. markets, and they closed in the green yesterday, but not nearly as high as they were earlier in the session yesterday. So from my perspective, we saw a big sell-off on Monday, and then we've seen continued what I would categorize as weakness in the markets, in the U.S. markets yesterday, although they closed green. And today, I believe the Nasdaq closed down over 1%, S&P just under 1%, and then the Dow was down about 250 points, something like that. So what does this mean? It seems to me that and you had Jamie Dimon coming out and commenting about an hour or two ago that he still sees recession as the most likely outcome. We all know, if you're watching this channel, others like this, that we're already in a recession and probably much worse than that. So let's see how this carries through with the markets later in the week. I saw cryptocurrencies were back down again, including Bitcoin and Ethereum down pretty substantially. Gold and silver under pressure again today. I believe gold fell about $7 an ounce. Silver was down 40 cents an ounce. The 10-year, the yield was spiking a bit, which usually translates into a sale of debt, selling off of debt. The dollar was a little bit higher today. So that's kind of a snapshot. Oil it's up pretty big. So are we going to see something in the, let's say, near future unfold in the Middle East with this Iran situation? Iran's been threatening now since the weekend, maybe even late last week, substantial retaliatory strike on Israel. A lot is happening. Two articles from Zero Hedge today I think are worthwhile sharing with you, and it ties back to the title of today's video. The first one is entitled "On Verge of Credit Shock. Credit card debt posts biggest drop since COVID crash as rates hit record high." Let me share the story with you. It says the Fed just reported June consumer credit data that was atrocious and confirmed our worst fears that the consumer has hit a brick wall. And again, comment below. I think we've all seen this unfolding for a while now. The consumer has been coming up against a brick wall, has been getting tapped out, and now we're starting to see this manifest in the data. According to the Federal Reserve's monthly consumer credit report, in June, total consumer credit rose just $8.9 billion, below the median estimate of $10 billion, and a material drop from the upward revised May print of $13.9 billion. While the total number was not shocking, it confirmed the recent declining trend, which always signals economic contraction, since without credit, U.S. consumers simply can't spend. It was the composition that was a big surprise. On the one hand, it says non-revolving credit, which consists of student loans and auto loans, rose by $10.6 billion, which was the biggest monthly increase since last June, so over a year ago. However, a closer look here reveals that the entire increase here was due entirely to student loans, which are once again being repaid after the Biden repayment moratorium ended in late 2023. Meanwhile, car loans, which are critical to keep the U.S. automotive industry in gear, have flatlined. As shown in the chart below, of course, quarter two, student loans increased by $10.7 billion, the biggest quarterly increase since quarter three of 2023, while car loans actually declined by $9 billion, the biggest quarterly decline since quarter three of last year. But while non-revolving credit saw a sizable increase, if entirely due to student loans finally catching up to where they should have been 3 years ago before the moratorium, it was revolving credit. And listen to this: revolving credit, i.e., credit card debt, that was the real shocker, because in June, it says revolving credit unexpectedly tumbled by a whopping $1.7 billion, and that is the biggest drop since the COVID collapse, it says. And more ominously, every time there's a sizable drop in this category, some economic calamity either follows or has already started. To get a sense of just how rare it is to get a negative credit card debt monthly change, consider that in the 6 years prior to the COVID crash, the U.S. had recorded just 5 months of negative prints, and all tended to precede major drawdowns in the economy. Of course, with the Fed refusing to cut rates for good reason, the brutal slowdown in new credit card debt is hardly a surprise, because in quarter two, it says the average rate interest-bearing credit card accounts just hit a new record high of 22.76%, guys. It is robbery. But what's happening is consumers are hitting their max. The reason why this number went down is that the consumers don't have any more rope. The end of the road is here. There's no more runway. There are no more credit lines to tap. And that's why that number is having a substantial drop. And it probably also is the fact that many consumers have already taken a hit on their credit and therefore their credit score, and they're simply not able to apply for and get any more credit issued to them. It says, with consumers ever more strapped for actual cash and equity, as the personal savings rate in the United States has collapsed from over 5% to 3.4%, the lowest since 2022 in just a few months, it says. There's only so much more credit card maxing out that can take place before reality finally sets in, as can be seen in the next and perhaps most striking chart yet. A credit card debt is an all-time high, while the personal savings rate is at an all-time low. And I'll tear this off and show you that chart. And the green is the personal savings rate, and the red is the credit card revolving credit debt change. Can you guys see that chart? See the green, that is plummeted, and the red is pun intended, is off the charts. So you have savings rate declining, levels of credit card, revolving credit card debt at all-time highs. So let's see where this goes. I think we all know, if it's not us, but people close to us in our lives are struggling. And a lot of it is due to the fact that they just can no longer put even maybe necessities on their credit cards. And when this actually hits, and maybe it's hitting and unfolding now, and now we're just reporting and seeing the data. But you have to feel for those that simply do not have enough resources without the use of credit cards to put food on the table, to pay for medical emergencies, to put tires on their car, to put gasoline in their fuel tanks. Those are the people, unfortunately, that won't have anywhere else to turn when they can no longer tap the Visa card or the MasterCard or the home equity line of credit, and they can't apply for and obtain any new credit. Okay, that's when we're going to start to see a lot of pain, more pain and suffering in this country. And what's that going to translate to? It's going to translate to higher crime, higher levels of suicide, higher levels of depression, you name it. We're going to see this unfolding drastically at an accelerated pace across this country. The next article I want to share with you talks from Zero Hedge as well. It's entitled Airbnb shares plunge on slowing U.S. demand as the consumer downturn worsens. Shares of Airbnb plummeted in pre-market trading in New York after the company reported disappointing second quarter earnings, falling short of Wall Street's expectations and issued a warning about slowing demand from U.S. vacationers. This development comes amid rising recession risks in the United States, with the consumer downturn worsening for the working poor and middle class due to elevated inflation and high interest rates. And now we can tack on maxed out credit cards and maxed out credit limits. Airbnb warned that it is seeing shorter booking lead times globally and some signs of slowing demand from U.S. guests. The bookings increased 8.7% in the second quarter, missing analysts' estimates of 126.33 million versus the 125.1 million that the bookings brought in. Airbnb expects, quote, sequential moderation of booking growth in the third quarter. That means they're expecting declines. People can no longer afford to take the vacations. They can no longer afford to book these rental units. In a consumer downturn, vacation spending is some of the first discretionary spending households cut to preserve cash. The problem is, as we've already cited numerous times, explaining low to mid-income consumers are under severe financial stress. And these earnings and dismal outlook are ominous signs that the consumer slowdown will likely worsen through the end of the year. So I don't think that this information or this story is any surprise to any of us, but I wanted to bring it to your attention. The Airbnb shares plunged 15% in pre-market trading. I meant to check the stock ticker and see where they closed today, and I forgot to do that. I apologize. But we're talking about the largest ever intraday decline for Airbnb, is what the article's saying. So we have credit cards maxed, consumers tapped out, which has been that way for some time now, but it's starting to really hit home now. The reality is really setting in, and of course we have now these companies that generate revenues off of rental units, and rental income is also crashing hard. So we're at 15 minutes here today. I don't have any better news to share with you. Let's see if there is any more of a dead cat bounce out of the markets, out of the cryptos, out of the metals. This could be the beginning, and again, I'm not an economist, I'm not giving financial advice, trading advice. This could be the beginning of a deflationary spiral, in which case all asset classes, guys, are going to be caught up in this. Some will recover faster than others. I was talking with a successful commercial real estate broker here in my area earlier. He's a friend of mine and also a client. And he said he believes, and he has one of the largest commercial brokerage houses here in this area. And he says 6 months, within 6 months, it's going to be a bloodbath. And he was looking to step in and pick up some deals. So that was coming from a very reliable source, someone who has their finger on the pulse of the commercial and residential real estate market here in my community. Since the pandemic, this area where I'm in Southern California, the desert area, has been the beneficiary of a huge influx of people from the Bay Area, San Francisco, from Washington, even from Los Angeles, right? Getting out of the bigger cities, the woke cities, and buying up real estate out here. And we've been a big beneficiary of this area of a very substantial upswing in values. We've also, I've seen a lot more people here year round now. A place used to be a ghost town during the summer. It really isn't as much that way anymore. So now we have this source of mine, friend of mine, client of mine, saying that he sees within 6 months the rug just falling out, or the bottom falling out. So I'll continue to report on what's happening locally. I'd love to hear from you guys in your areas, wherever you're at in the United States or across the world. What are you seeing? Okay, I think we're going to keep seeing softening in the job market, higher unemployment, more job losses. Again, it's not doom and gloom. It's the reality of what's happening. For those of you that choose to keep your head buried in the sand and not acknowledge it, and therefore not plan for it, I feel sorry for you. Okay, if you're one of those people. But most people here watching this channel, I believe, understand what's happening. If it's not happening directly to you, it's probably happening to people that you know or you love, and it's probably going to keep snowballing. Okay, so I'll leave it there today. I'm going to be leaving in about an hour and a half to get my workout in. I'm finally back on track. I kind of crashed over the weekend. I just underestimated the toll the travel was going to take on me, but back on track. Hope you guys are doing the same. Get your steps in. Let's continue to become more physically fit as a nation. All right, it all starts with us doing our part and hopefully influencing those around us, our family, our friends, our colleagues, to do the same. To be smart with their diet, to be smart with their exercise routine, and simply make the effort. You're not going to see immediate changes, depending on what kind of moves you have to make with your diet and maybe with your weight and your physical fitness. But you've got to start somewhere. Put one foot in front of the other. I want to keep encouraging that, as well as I always do. Repetitive nature on this channel is encourage you guys to seek out a source of alternative revenues for you and your family, some sort of side hustle, additional, let's say, avenues that you can have in the event that you lose a job, or that a close family member or loved one loses a job and you're called to step in to kind of fill the gap. Okay, that's going to start happening more. I think we're going to hear about that more, and that's the reality. So keep that in mind. Appreciate all of you. Let's whatever's happening with this channel and with the holdback, let's do me a favor. Let's kind of show them that we're growing. We're going to continue to grow. That these are the channels that are important, for everyone to watch. It doesn't matter what age group you're in. I really want to start reaching more, as I said in prior shows, to the people in their 20s and 30s and even 40s, right? That have never gone through a real financial downturn. All right, I lived through. Was practicing during the 2000.com bubble. I was practicing law and lived through the great financial crisis, and so I do have some perspective. I've seen it. I was caught up and got stung pretty badly in 2008. With a property issue. Go back and look at prior videos about the foreclosure. So no one is immune from it. Things happen, circumstances that you can't always plan for, unforeseen issues. So let's take a broad-based approach to prepping. It's not just having food and water put away and security and medical supplies. Yes, it's all those things, but it's also planning with your finances, planning to work on your credit score, and making yourself just a more well-rounded, healthy, productive individual. Right at 20 minutes today, a little bit long. Again, thank you guys for being here, and I will likely touch base and speak with all of you tomorrow. All right, have a great evening. Bye.